This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend podcast. This week, a batch of U.S. economic data setting the stage for the upcoming Fed meeting on Wednesday, and yet, gotta say, top of mind, an election outside the United States. Also, the meme stock darling that continues to enwrap Wall Street. On the latter, we catch up with the author of The Trolls of Wall Street, excerpted in the current issue of Bloomberg Businessweek.
Plus, Franklin Templeton and BNY Mellon are two giants in the asset management business. Jenny Johnson, president and CEO, Franklin Templeton, and Hanneke Smits, senior executive vice president and global head of investment management at BNY Mellon, share their outlooks.
All of that to come. We begin with the elections in India and the surprising outcome as Prime Minister Narendra Modi's party lost its majority in parliament. Modi must now rely on allies to form a government for the first time since he stormed to power a decade ago.
India's stocks had their worst day in more than 4 years following the results. To understand it all, we leaned on the expertise of Bloomberg News senior editor Bobby Ghosh, who previously covered foreign affairs with a special focus on the Middle East and the wider Islamic world. And he was Time Magazine's Baghdad bureau chief prior to joining Bloomberg.
Well, it's striking because this is a figure, Narendra Modi, who has dominated the Indian political landscape like no politician going back a couple of generations. For 10 years, he's been front and center of Indian politics. He sort of commanded an aura of invincibility. And his party, which is very, very good at messaging, very disciplined at messaging, conveyed that message ahead of this election. And this election was not just a referendum of his party, it was very much about him. The entire messaging of the election was around vote for Modi, even though this is a parliamentary election. So if you can imagine, the closest American comparison would be if in the midterms the Republicans went out to all their voters in the Senate and in the Congress, but their message was vote for Trump.
Right.
Not for me, vote for Trump. That was the kind of messaging that went into this election. And so this is a personal failure on the part of Modi. They'd set the bar very, very high, 400 seats. They've gotten the bare minimum to get a majority is 272. The party by itself looks more likely to get 240. Now, it has allies, and it can form a coalition, so it's very likely it'll remain in government. Modi may remain prime minister, but his personal prestige has taken a real battering.
Modi already spinning this as a victory.
Yeah.
Where did the pollsters go wrong? Why did we see the exit polling show such a stark difference to the vote tally? Explain.
Well, I think some real deep investigations are going to have to be done into that exit polling. The numbers are so, I mean, we've
That's
become
why this
used
was
to
so
it, right?
shocking.
Yeah, we've become used to it in recent years all over the world. People tell pollsters one thing, and then when they go to vote, they do something else.
Right.
This is a problem in this country just as much as in others. But the gap between what the exit polls are showing and what the results now seem to be indicating, I haven't seen a gap that wide in any major election anywhere in the world. So something has gone terribly amiss. This is not simply, I would suggest, not simply a case of people telling pollsters one thing and doing something else. I think something more structural might be, there may be more structural problems here.
I want to get your comments, though, on voters feeling left out of India's growth,
Yeah.
the growing inequality, pervasive joblessness, rising labor costs. Feels very, very similar. What is this a vote against, though? Is it a vote against Modi, the personality, or a vote against, listen, I don't feel so good?
Well, for one thing, there's a strong anti-incumbency vote, right? This party has been in power for a long time. People would like to see the other side get a try. That's just human nature that happens with democratic elections all over the world. But the other thing is that Modi's message of economic success has left out huge numbers of Indians. This is the world's most populous country. And a lot of Modi's messaging is, look at how many billionaires we've created in the last 10 years, or in the time that I've been in power. 800 million Indians still depend on highly subsidized handouts from the government, from food, and that cohort of people, that's a lot of people, were not included in this message of look how many billionaires we've created. And a lot of the votes, as the patterns that we're seeing is that he seems to have lost a momentum in rural parts of the country. Farmers, those are the poorest of the poor in India, tend to come from the rural heartland states, where for a long time Modi was dominant, the BJP was dominant. Their message was vote for us and all boats will rise. You will rise up from this menial labor you're doing in the farm, and you too will have a chance at economic success.
Why isn't it rising up? I don't want to go trickle down, I feel like, but why isn't it spreading out?
Well, that's
the
the
wealth?
nature of so much of India's economic growth over the last many years, is that it has not been a growth that has included everybody. The problem of unemployment has not been reckoned with in this growth. This is a jobless growth for a large part, for the most part. It is not creating enough jobs. This is a giant country, huge numbers of people, tens of millions of people are coming into working age every year. The economy, even though it's one of the fastest growing economies in the world, is not creating tens of millions of jobs. So there's a square and there's a circle, and these are not going to match.
So continuing with the economic implications of this, we saw the stock market, or we saw Indian stocks, I should say, have their worst day in more than 4 years.
Yep.
Obviously, markets don't like surprises. But I do wonder about the economic implications of this globally, Bobby, and what it means for a country that is trying to transition from developing country to a developed country.
I'm not terribly worried about the Indian economy, I will say this, because so much of Modi's economic policies were built on a platform that the previous government, dominated by Congress Party, laid down those foundations. Now the Congress is back. In terms of economics, in terms of needing investments, there's not a whole lot of sunlight between the BJP and the Congress Party and its allies. There may be some differences in prioritization, but for the large part, they both agree that India needs foreign investment, Indian economy needs reforms, Indian businesses need support, India needs to be creating more jobs, and those jobs have to come primarily from the private sector. There's a lot they have in common in their economic vision, although if you ask them directly, they would deny that furiously. Equally on foreign policy too, this is the same thing. Both countries recognize that India's association, India's ties with the United States are crucial, that India and the United States have a common concern about China's growing influence in the world. India, which borders China, which went into war with China in the early 1960s, feels the heat very closely. I don't expect big changes there. I think a lot of this has been, the election has been to a substantial degree about how the parties regard minorities in the country. The BJP, which is a very Hindu nationalist party, during this election, more than ever before, there was some really strident anti-minority and particularly anti-Muslim speeches from the Prime Minister on down. The Congress Party and its allies come from an older, more secular, more inclusive kind of politics. And I think that is what won out at the end of the day. But more than, again, to come back to where I started, more than anything else, this is the Indian voters voting against Modi rather than voting for anybody.
So, Bobby, is this the beginning of a new chapter in terms of India's political history?
It could very well be. We've seen this movie before.
Okay.
Coalitions, large unwieldy coalitions, trying to form a government, sometimes succeeding but not being able to hold together the sum of their parts, and another election coming up in quick succession. Now, if Modi can hold together his coalition partners, and the two main coalition partners are notorious for switching camps. They've done it so many times in recent years. If he can hold together his coalition, he will continue to be prime minister. But he will no longer have that swagger, and he will have to deal. Momentum is everything in politics, right? He will have to deal with an opposition in parliament that is much stronger than before, but feels like it has the wind in its sails, that will feel more emboldened to press against his policies, to push against whatever he's trying to do, particularly on social issues. And so he will not be able to govern with the confidence that he had before.
So, Bobby, if he's not able to govern with the confidence and swagger that he had before, where should we look to for change? Where would you expect to see changes as a result of this election outcome?
Well, a lot of the changes will be more optical than actual, shall we say. I think the fact that the rejection of this politics of bigotry, the politics of identifying and targeting minorities, the politics of sort of a majoritarian view of religion, that India should be Hindu, I think all of that will recede, at least for a while. You know, a great deal is going to depend on what the opposition can do with the momentum that it has.
Right.
Rahul Gandhi, who's leading the opposition coalition, has not been in this place before. He is an untested quantity in this situation. He has run a Congress party that has long been a family fiefdom, and nobody dares to raise a voice against him. He has not had to be conciliatory. He has not had to include lots of different voices in the decision making. As a leader of a coalition, he'll have no choice but to do that.
Well, that's what I was thinking about, because in our reporting, it pointed out more than 20 opposition parties formed a united front against Modi. And I think about, okay, united front against one, but then you have to take those groups, right, and figure out the way forward.
Yeah. So now, do you make a play for Modi's allies and try to bring them on your side and try to form a coalition with 24, 25 different parties? Or do you sit back and say, no, we're going to be in opposition, we're going to be a strong opposition, we're going to let Modi dig himself into a hole? This is a very crucial decision that has to be taken first. And then the real practical day-to-day difficulties of herding all these cats together. Right. It's one thing when you have a common goal of defeating Modi.
That was Bloomberg News senior editor Bobby Ghosh.
Coming up, from the serious to the sublime, GameStop, a big trade this week. Again, how the outcasts and insurgents are hacking the markets.
It's all in a new book.
It's a fascinating topic that I do think most people forgot about since January 2021, when GameStop was really in the news and you couldn't avoid it. I think a lot of people thought that this was going to go away when GameStop went down, but more than that, people thought it was going to go away when the pandemic was over and these young traders would go home.
You're listening to Bloomberg Businessweek. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
GameStop was a focal point on Wall Street this week. The meme stock darling during the pandemic surging after the Reddit account that drove meme stock mania back in 2021 posted what appeared to be a $116 million position in the video game retailer. We're talking about none other than Keith Gill, who also goes by the name Roaring Kitty. GameStop shares were already up a cool 108% this May, its best month since January of 2021. And the stock was up another 22% in the first week of June, even after shares slumped 39% on Friday. This happened after the company unexpectedly released earnings and announced plans to sell up to 75 million additional shares. And Gill hosted a YouTube live stream watched by hundreds of thousands of people.
We can't talk about meme stocks without talking about Wall Street Bets, the Reddit message board that, according to our next guest, quote, would eventually come to occupy a key position at the center of a movement that turned millions of young Americans into investors and traders.
That line from a brand new book that comes out on June 11th called The Trolls of Wall Street, How the Outcasts and Insurgents Are Hacking the Markets. The book by journalist and author Nathaniel Popper.
It's a fascinating topic that I do think most people forgot about since January 2021, when GameStop was really in the news and you couldn't avoid it. I think a lot of people thought that this was going to go away when GameStop went down, but more than that, people thought it was going to go away when the pandemic was over and these young traders would go home. And, you know, I'm writing this book about the story of how this happened, how this sort of online movement came to be. And one of the most surprising elements of the story is the way in which it has not gone away. Mm-hmm. You look at these statistics that we now have around retail traders, and you see that retail traders are still in there buying stocks and trading at the same level that they were back basically in 2021 when GameStop was happening. So, this latest GameStop moment is just a sort of reminder of the fact that this whole world has not gone away.
All right, but it continues to play around with these stocks that, many of us question the fundamental stories here. Sure. So, I understand the lasting effect. It feels like a little bit like a video game I'm playing and so on and so forth. Is it something though, okay, so it sticks around, but does it somehow broaden out and start to get into some names with fundamental stories?
That's a very important question for the future of the markets and for the future of the portfolios of all the people in this world, right? Look, on one hand, you have the importance of the meme stock movement in itself. And I think part of what's so interesting about meme stocks and GameStop is that there's something deeper going on there. People figured something out about the markets. You're right that in the end, GameStop going up was not about fundamentals. It was about social media personalities. But there was some discovery in there by the crowd of these weird market dynamics around options and market makers. And there was this sort of educational process that was happening there. It's derided as this sort of idiotic flare-up, but there was something deeper going on there. And that deeper thing taps into your bigger question here, which is that our focus on meme stocks and GameStop, I think, has distracted us from the fact that this whole movement has broadened out significantly and now is much bigger than meme stocks. And in fact, meme stocks have gone down as a proportion of all retail trading. I think what you've seen is that retail traders, they're always thought of as the dumb money. But when you're in the markets and when you're investing and when you're trying things out, you learn things. And that you have seen that over time. You see that in this data that shows the trends, the trends that retail traders are following. And as I mentioned, the percent of all trading that's gone to meme stocks has gone down, and the percent that's gone to electric cars and AI plays and NVIDIA has been enormous. And so coming out of, 2022, 2023, we had this market downturn. And that was another moment where everybody said, okay, these retail guys are going to get slaughtered. They're done. You see coming out of that the retail guys were buying when the markets were at their low, and they were not just betting on meme stocks. They were betting on AI plays. And so you see this sort of interesting migration. Obviously, it's also present in the whole crypto world, and that keeps going, and that's come back in ways that people didn't expect. But The idea is this thing has gotten bigger than any one place. It's bigger than Wall Street bets, certainly.
That's so interesting, Nathaniel, but I do wonder to what extent the folks who you feature in the book, and then also the folks who just lurk in Wall Street bets, have actually made money, because there were so many stories post meme stock craze of 2021 of individuals losing fortunes, losing everything.
So I think, I want to sort of split this into two halves. One of which is the sort of cultural phenomenon. And I think, losing has actually been a sort of central part of the Wall Street bets sort of culture, going back to 2015, going back even earlier. I mean, this place has now been around for more than a decade. And part of the culture was a recognition we're doing something stupid. It was about getting attention. It was part of this whole sort of 4chan trolling online culture that, by the way, I think is deeply interwoven with Donald Trump and the alt-right. I mean, all of this stuff, I sort of explain how it played, these different movements online played off each other over the years. And Donald Trump became this important figure on Wall Street bets. And part of that was this weird trolling culture where you're both joking and being serious and you're doing stupid stuff, but it's also smart at the same time. It's a very sort of complicated online world that I tried to untangle. But so that is one piece of this, and losing is a part of it. And there are, I chronicle some of these sad stories in my book, and including this suicide that really hit this community hard because of some of these losses. But at the same time, I tried to look at the data for both how Wall Street Bets was doing and how retail traders were doing more broadly. I think what you see there is a slightly different story. As retail traders have gotten into the markets, they, as I mentioned, have learned, and the markets have come to seem less intimidating. And so, the markets used to be a thing that young people largely avoided. The markets were something for old white dudes who, were retired. And now it's something that kids care about. And the big picture data shows that it's very good that kids care about the markets, because the markets are a very good place to have your money. And even if, let's say you're making, you're trying to time NVIDIA or Apple, maybe you're not going to make as much as an index fund, but it's better you have your money in the markets than that you're just sitting on it, in your savings account. So that's the bigger transition that interests me.
Okay, Nathaniel, we got to talk about a couple of the main characters in the book here. Jamie Rogozinski and Jordan Zazera. Who are these guys?
Jamie is the founder of Wall Street Bets. He's a guy back in 2012 who created this subreddit. And at the time, it was basically an escape from his alcoholism. He was basically a 30-year-old guy working at a job he didn't really like. And he was looking for basically ways to fill his hour when he was at home drinking alone. And he began trading, and he realized that trading was much more entertaining than he thought it would be. And he liked talking about it with people. And so he created this subreddit, which he called Wall Street Bets. And what's so interesting about Jamie is that it turned out that there were a lot of other guys in a similar situation, guys who were sort of struggling in life, struggling to find their place, feeling sort of alienated. And this community grew up around him, and he found company in it, and it created this strange culture that we now know of as Wall Street Bets. By the time he got kicked out of Wall Street Bets, which is one of the interesting chapters in this book, Wall Street Bets had attracted 1 million members. And that was when the sort of next phase of Wall Street Bets happened, which was really during COVID. And that was when this young guy named Jordan Zazera took over as the sort of main moderator for the subreddit. And he is another interesting character who's never really found his place in life, never really got a job he liked. And he found this community, and he found something so meaningful and rich in it, even in all of its twisted humor and dark humor. I mean, it's a weird place, but the strange thing was this had a real hold on the people who came there, and it became a real community. And I think that's something, again, when we talk about meme stocks, it's easy to miss the way in which this feeds into this much bigger culture and this much bigger set of needs that the young guys coming there have.
I'm wondering about this idea of, quote unquote, sticking it to the man, because there were moments during 2021 where that was a big part of what Wall Street Bets wanted to do. They wanted to show those hedge funds that they were smarter. They wanted to outsmart the hedge funds that were betting against GameStop. Were they successful? Did they stick it to the man?
Yes and no is my maybe disappointing answer. But I think that what has happened has led to a real chastening of institutional investors. Institutional investors have realized that these traders are a real power in the market when they come together. The David Goliath story, there are a lot of these little Davids who lost money, but there are really also a lot of Goliaths who lost a lot of money in this. Even when you look at just the amount of short selling that hedge funds on Wall Street do, it has just gone down. I mean, it's not as though it just went down and came back up. There is a fear in the markets, and it has changed the dynamics. And that goes back to the idea that this online community, like so many online communities, is about distrust. And obviously that's playing out in politics, that's playing out in the presidential election, but that's also playing out in the markets.
That was Nathaniel Popper. author of The Trolls of Wall Street, How the Outcasts and Insurgents Are Hacking the Markets.
Still ahead on Bloomberg Businessweek, Franklin Templeton has $1.6 trillion in assets under management. BNY Mellon overseeing nearly $50 trillion in assets for its clients.
Developed economies have aging demographics, and developing tend to have younger demographics, except for China, obviously. And it's going to have an impact on investing. There's going to be opportunities, but it's also going to drag down economies as a younger, smaller workforce has to support the folks that are older.
Franklin CEO Jenny Johnson and BNY Mellon's Global Head of Investment Management, Hanneke Smits, are up next. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Investors are uber focused on this week's coming Fed meeting. I was in Nashville this past week for BNY Mellon Pershing Insight 2024. It's a gathering for the wealth management industry. At it, I moderated a keynote with two senior executives in the asset management business who see so much and who shared their outlook and views on everything from AI and alts to debt, deglobalization, demographics, digitization, and geopolitics, and a lot more, Tim.
Here's some of that conversation that Carol had with Jenny Johnson, President and Chief Executive Officer, Franklin Templeton, and Hanneke Smits, Senior Executive Vice President and Global Head of Investment Management at BNY Mellon, on the macro backdrop.
Franklin Templeton, $1.6 trillion in assets under management. BNY Mellon overseeing $50 trillion in assets for its clients. You both see a lot, your firms see a lot. What are some of the broad secular trends that you're seeing that are really shaping the global economy and will influence the investing landscape for years to come? Jenny, let's start with you.
Everybody's talking about kind of whether you have 5 or 3 or 6 Ds, but I'll start with the Ds. Look, demographics is going to be key, and it's going to be, the developed economies have aging demographics, and developed economies have aging demographics, and developing tend to have younger demographics, except for China, obviously. And it's going to have an impact on investing. There's going to be opportunities, but it's also going to drag down economies as a younger, smaller workforce has to support the folks that are older. And then those economies that are developing with it, like India, 56% of the population of India, 1.4 trillion people, is under the age of 25. So as long as they can educate them, right, they can be participating in it. So demographics is important. Obviously, I'll call it disinflation, so we can say our Ds, obviously where the interest rate environment goes. The supply chain, sort of reorienting supply chains is going to be, I think, opportunity from an investment standpoint. It's also inflationary. There's a reason we were in China. The China plus one story, you were in China because it was cheap. Right, so as soon as you start to decouple and change your supply chain, you're going to end up adding some cost to that. Not to mention tariffs and others from a geopolitical decarbonization. Right, unfortunately in the U.S. it's become this red and blue state conversation. Obviously, Hanneke, you're based in London. You go to Europe, it is still a huge focus, and the reality is over 90% of the world's, governments that control 90% of the world's GDP have committed to net zero. Whether they get there or not is irrelevant, but they're focused on investing on that. And then finally, I'll call it digitization, is just this, we're living in a massive technological advanced age with AI, things like blockchain, and those are going to drive investment results. And then I got to throw in U.S. debt. I don't think we're talking enough about the longer term impact of U.S. debt.
I feel like it's safe to say that all of us have spent our careers a few years ago, a few decades ago, where it came up in every market conversation. Then it went away. It is back, and I feel like with a vengeance. All right, Hanneke, let's go to you. In terms of the global macro.
Yeah, so Jenny summed it up very well, and we're sort of seeing the same trends. I was actually quite interested to see that the audience here, so when you think about the trends, actually feel optimistic about investing.
Are you surprised?
Well, yes and no. And I would say the ones that, when you take a step back and think about these trends create uncertainty, but those trends and uncertainty can also create opportunities, right? Because when there's more volatility in markets and in responses, people will respond differently, have different needs, and that can create investment opportunities. Now, having said that, in this world of what appears to be disinflation, we have an expectation that generally we're still at rates higher for longer, but we are expecting, with the information that is starting to come out, tighter, or sort of lower, tighter employment, that we are expecting to see some cuts later in the year, but we're not going to go back as low as where we've come from. And I do think we're going to get back to an environment where having higher interest rates is more the norm than the environment we've come out of.
One thing I want to ask you, and I think, we have the conversation that, hey folks, it was the low rate environment or zero rate environment that was the abnormality.
Yes.
Right? That what we're doing right now is getting back to normal. Having said that, you have a generation of investors, advisors, who were used to this disinflationary environment. How does that, Hanneke, let me come back to you first. How do we need to kind of address that? How do we have the smart conversation around that, in terms of investing and what it means?
So it's two ways, right? To sort of how we deal with it in our own organizations. We do, I'm sure you have it as well, Jenny, in our own organizations, people who have only been trained as investors this side of the GFC. I'm of the generation that was also investing well
it's good
before,
to be old.
Well,
Get to see a lot of cycles.
And actually,
I call it season.
Investment management is actually, thankfully, a sector in which experience really matters. Yeah. And you sort of do realize that there is such a thing as cycles. But it does mean that we need to educate not only our own investors, but also our end clients in terms of what this type of environment of sort of having positive interest rates, let's call it that, means for investors and what it means for asset allocation. So we're spending a lot of time educating our end client, our advisors, but also our own workforce.
Jenny, your thoughts on that?
Well, the reality is I think we're getting into what historically is a more normal interest rate environment. And if you look at it, the economy has actually been able to absorb the rates increases pretty well.
It's pretty aggressive in the last year, right?
Yeah, very aggressive.
Yeah.
I describe to people as like, of course you're going to see
whiplash.
some slowing down data. They jammed on the brakes, right? Exactly, it's whiplash. But we're also in the camp, and I caveat it with that Franklin Templeton. So we're 1.6 trillion, but we have 5 different CIOs who have slightly different views, macroeconomic CIOs that have slightly different views. So it's a little bit like.
Is there a lot of debate there?
Oh, huge debate. Matter of fact, that is insisted that especially the ones that are the furthest apart, to make sure that they're at least having an internal debate on it. But, I tend to, and it's obviously converged over time, but, rates are higher for longer. The economy has definitely absorbed it pretty well. And, if I were to guess, I think it's maybe just one rate increase this year.
But I think you're right, because there also, to your earlier point, there continues to be inflationary pressure from emanating from the supply chain as well, right? So
right.
You look at also the conflicts around the world, which is putting pressure. Certainly, we've seen it being based in London on our doorstep. We've seen it in energy prices. We've seen it in food prices. Mm-hmm. It's coming down a bit. We're seeing that the Middle East conflict at the moment is also putting pressure on the supply chain. You and I were talking earlier about aviation, Carol, and flights. I mean, you can't just simply fly, or airlines can't have to reroute where they go. My flight, anytime I go to Japan from London, the flight is taking an extra 2.5 hours because we're not going over Russia. So think about the cost of time, the cost of fuel, and those costs will have to get passed on in the price of goods. So it's that inflationary pressure, I think, is still there.
These go ahead. No.
I was just going to laugh. I was going to say, one of the advantages that all you have is you're from all different places in the U.S. Because sometimes I always say, My mother was a doctor, and she said one thing that always bothered her about doctors is sometimes they didn't just look at what was in front of them. They always had to be proven through research, and sometimes it's obvious in front of you. If you talk about the environment around you, I bought a truck for the farm this weekend, and I used to finance. I ran a financing company of autos, and so whenever I bought a car, I'd go into the dealership and say, show me your invoice, and we'll start there and work our way up. It was, let's start at manufacturer's suggested retail price, and we'll tell you what fees we added. And it took me 3 months of walking out. I finally asked somebody in California, can you see what you can get there? I was not going to buy a car for above MSRP. And you know what? In the end, I ended up doing that. It has changed so much. And so, you walk into a restaurant, are they still pretty full? You guys, again, you only see where you're going, but as you ask each other around, it feels like it's still pretty robust out there.
What concerns do you have regarding the rise of nationalism and populism pushing us away from globalization and its effect on those emerging markets? Like what you folks are talking about feels like not going away anytime soon.
Agreed, and that's inflationary.
And that's inflationary.
It is. No, I agree as well. I mean, it's been a concern of mine and of ours for some time, this rise of nationalism and also the benefit. So our generation has really benefited from what I would call the peace dividend, right? Following sort of the Second World War. And it was all about globalization. We all read the book, The World is Flat, that came out, didn't you, Jenny?
Yes, I did.
Sure you did, some 20 years ago. But that is changing. Jenny was talking about earlier, we were all moving manufacturing to China. That is no longer happening. We're sort of reshoring, and that is adding to cost as well. So it's some mix of nationalism, then a much more tense geopolitical environment as well. You throw that into the mix, and it is making for a much more combustible environment that I think will provide a challenge for corporates over the long term, notwithstanding what we're seeing today.
And just I want to hit on the debt piece, because again,
let's go there.
I don't think we talk about it enough. So,
because there's a question. Wait. Large debt has been an issue for a long time, but appears to be worse than ever. How do we fix it? So,
and it was funny because on Bloomberg this morning they were like, "Well, come on, we always talk about debt."
Did you hear that? Jenny listens to Bloomberg. Love you. All right, go. Now you can go.
They were talking about, come on, it's always been an issue on debt and it never seems to be a problem. Okay, well, in 2007 we had $9 trillion. We're now, I thought it was 33. Somebody said
35.
Okay, 35 trillion.
120% of gross domestic product.
Yeah, exactly. And then people say, well, Japan's 250 and they're, okay, except our largest buyer of foreign debt is Japan at 1.1 trillion and China number 2 at 800 billion, okay? We are not at threat of not being the reserve currency. We're going to continue to be the reserve currency because there's nowhere else that anybody's going to go.
That was Jenny Johnson, President and CEO at Franklin Templeton, along with Hanneke Smits, Senior Executive Vice President and Global Head of Investment Management over at BNY Mellon. Catch that full conversation. Just head to bnymellon.com.
And that wraps up the first hour of the weekend edition of Bloomberg Businessweek from Bloomberg Radio. Coming up in our next hour, not easy being a CEO, especially in your first year. Enter Ty Wiggins, part coach, part cheerleader, and part advisor.
Plus, women are increasingly stepping up to the tee, golf tee that is, from the president of the PGA Tour's Superstore. And travelers, they're still traveling. We'll talk about that with Hilton's CFO.
And speaking of travel, why one hotelier is not putting guest needs first.
I love this story. It's all coming up. This is Bloomberg Businessweek.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek, including lessons from the top of the C-suite with the author of The New CEO on the tips, tricks, and mistakes to avoid for first-time chief execs.
Plus Hilton's CFO on opening 2 new properties every day. And our Pursuits team on the anti-hotel and rise of regenerative tourism.
Also, move over, guys.
Okay.
A record number of women are now hitting the green. Jill Spiegel, president of the PGA Tour Superstore on women taking on the game.
First up this hour, you might recall that last month we got some news in the world of executive transitions. JP Morgan CEO Jamie Dimon saying his succession was, quote, well on the way and could come sooner than 5 years. Morgan Stanley chairman James Gorman has also announced he will cede his role at the end of the year.
Managing CEO transitions can be a complex challenge for many businesses. Sometimes the new leader within their first few months makes a poor decision or is unsuccessful in connecting with their employees or board. Bottom line, Tim, not great.
Enter Ty Wiggins. His job is to guide CEOs through their first 12 to 18 months, often acting part as a coach, part as a cheerleader, maybe a venting partner, a challenger, and always an advisor.
I feel like I need one of those people. Don't we all?
I mean, I know people who can be your challenger.
You are. I know lots, actually. All right. It's all, though, in Ty's new book. It's entitled The New CEO, Lessons from CEOs on How to Start Well and Perform Quickly, minus the common mistakes. Ty Wiggins is also global lead of CEO and executive transition practice at Russell Reynolds Associates, an executive search firm.
The opportunity in the book here is to understand the pressures and the challenges that CEOs go through in their transition. And I think if you're a senior leader or an executive in an organization that's undergoing a CEO transition, the book will give you insight into how to best support and also slot in with the new CEO.
Well, talk to us about who you talked to for this book to get some insight. And, what is so important about maybe those first few days, first few weeks, first few months for a CEO on the job? Because I got to say, I feel like CEOs move around a lot as of late, and especially if it's a publicly held company and the stock isn't doing well, activists are out there or media's all over it, and there's a lot of pressure.
Now, in terms of the book, interviewed close to 40 CEOs and then had the opportunity to speak to CEOs such as Ramon Laguarta of PepsiCo and Hans Vestberg of Verizon, Carol Tomei of UPS, and a string of others that are sort of cited in the book. You're right, CEO tenures are decreasing, which puts pressure on this early period in order to get a good start. And I think some of the early actions that CEOs take need to be really well thought through. We know that some key factors are the state of the business that they inherit, how quickly they assemble the right senior leadership team around them, and importantly, what the former CEO does and how that individual leaves the organization.
Share with us, though, in some of the conversations that you had with CEOs, what did you get from them about that first year?
A lot of humility, which was really good to hear. I mean, these are great CEOs, as you've mentioned, and some of them came internally within the organization. And I think there was a common thread around how difficult the CEO role is, how there's no real sandbox for it in terms of getting ready. It's a shock. We've talked about the loneliness a lot across different medias, and it's an actual issue for a lot of CEOs. And the responsibility. When I ask what the best and worst part about being a CEO is, often the answer is the same, the responsibility. So, these are individuals that want the responsibility, they want to lead, they want to have an impact on the organization and their community, but they also feel the weight of that responsibility in terms of being responsible for the financials, but also their employees, families, etc., in terms of the market and the communities that they lead.
What do you think about like those CEOs that are at a company, leave, and then they come back? Like a Bob Iger, of Disney, revered.
Or like a Howard Schultz.
Or a Howard Schultz, right? Come back and, their track record was incredible when they left, certainly Bob Iger, right? And then came back into a situation where the company was under some pressure because of its streaming pivot and so on and so forth. Is he like kind of starting from scratch again a little bit because some of the dynamics have changed?
I think it's, to have a CEO return, depending on the individual and the organization, it can represent a number of things in terms of a succession that hasn't been successful. It obviously shows a passion and a love for the organization to come back. In many cases, it's disruptive depending on the time period, because we do expect the new CEO to see the world differently and to take a new long-term view of the organization. So if there are changes that need to be reversed, that could be a little bit unsettling. But I think for the individuals involved, I think if they're leaving at the right time in their career, then, I think it's less than ideal for them to need to return. But, each individual case will be different.
Ty, we've heard criticisms about boards being too close to their CEOs. Tesla, for example, one of the board members there is Kimball Musk, Elon Musk's brother. Are boards too close to their CEOs? Shouldn't they be more independent from one another? They're supposed to keep them honest, right?
Absolutely. I mean, the board role is crucial to the governance of the organization, and they do play a specific role. And one of those key roles that they play is to hire and fire the CEO. And so this is, any CEO transition lands heavily on the board as well. As all groups of individuals and within organizations, it can be quite a challenge to continue to maintain that independence, especially when you have a very successful, very dominant CEO.
Should CEOs be allowed to serve as chairs of boards, in your opinion?
Well, I think it's common practice in a lot of organizations, especially in the United States. In other countries, it's less common. I think as long as there is a independent, senior director to provide that counsel, that support, and that challenge, it does allow CEOs to move with greater pace. So if the organization is in trouble, then that allows for quicker decision making. But I think that if we look at the independence that we require, there's argument for the CEO to be separate to the chair role.
Having said that, is there a common mistake in talking to CEOs that you find that they all say, this is the one I made? Is there a common mistake among them?
The common mistake is generally around something that they say in a fairly public environment or an early action that they make without enough context and without enough information. And this is a question that comes up a lot. And the answer is really, it's any mistake that causes the board to doubt and to where you might lose the confidence of the board, because that obviously significantly impacts your tenure and your ability to deliver longer term.
Hey, this kind of spoke to us. There is a section in the book about dealing with the street. And here we are, coming off an earnings season, but we're always thinking about the next one. But you do talk about Mark Klaus, who was CEO at Pinnacle before joining Campbell's, and just the level of engagement and communicating with investors when he got to Campbell. I mean, that can be a big thing and kind of a real eye-opener, right, for CEOs who are early in on the job.
Yeah, absolutely. Unless you've been a CIO or a CFO and had extensive experience, the investor relations will be fairly new, and it's a challenging period of time. The people will often underestimate the amount of preparation that goes into delivering results and doing the investor roadshows. And, trying to form that relationship really early to get buy-in to, what you're planning to do and what you're thinking about doing. So, this is where it's really important that you surround yourself with good IR people and, people to support you in those conversations. And, if it's early in your tenure that you deliver results, then you have a little bit of grace. And you should take full advantage of that.
Hey, one of the things that we wanted to get into, and Tim is in our prepping for this, Tim, you kind of highlighted this, but executive compensation, CEO compensation. I mean, I think about sometimes when there's a company in trouble, right? Peloton, and you have Barry McCarthy comes in. He just stepped down as Peloton CEO, had total compensation of $168 million in 2022. To be fair, most of that compensation, 99.7, was option awards, so tied to the company's stock price. But it's a lot of money for a company that's, got a dwindling market cap. I think barely over $1 billion here at this point. It's I hear what you're like. It can be a tough job. I understand. There's a lot that comes out of CEO today, but it does feel like they're taken care of.
Yeah, compensation is not an area that I get involved in. I know that it's a contested issue. I know that the CEOs that I work with certainly are really aware of that in terms of their role. It's nice to think that the people that I work with, especially, this is not the driving force for what they're doing, why they're doing what they're doing. And it is really about the opportunity to have an impact over such a large group of individuals, and a responsibility and I guess a belief that they can do better and make improvements and, really serve. So, again, I probably have a privileged group, but that's not the key driver for why they're doing what they're doing.
Hey, one of the things I do want to go to is Chapter 11, if I could do it all over again. And you share a collection of pieces of advice from some of the CEOs you talk to.
Yeah, when people reflect on their time early in their CEO role, there's a couple of things that come up. Most often, the most popular is that they would move faster on their executive leadership team. Being CEO is a role you can't do on your own. You must have the right people around. And for a bunch of reasons, we don't move as quickly as necessarily our gut is telling us to move. And there are other restrictions in terms of momentum. So the first is that they would move faster. The second is that they would engage the board more effectively and earlier. So similar to dealing with the street, working with a board for the first time as CEO, not as a senior executive, is quite a shift. And you usually spend more time on board and board-related activities in your first year than you expect. So you really need to factor that in. And the third is that they would flex their leadership style more. So they hang on to some of the things that served them well before without really accepting and stepping into the full gamut of the CEO role, accepting the good and the bad parts of it, in terms of driving the outcomes that they know they need to deliver based on what they've promised the organization and the board and the market. This is one of the things that you see second-time CEOs do much better than first-time CEOs is this pre-contracting with the board, is outlining, this conversation of when, not if, I want to make a significant change or point the organization in a different direction. How are you going to respond?
Yeah. And
in Hans's case, he was really keen to make sure he didn't get 6 or 12 months down the track and have the board say, I didn't know you were going to do this, or I didn't know you were going to do that. And it was really key to him moving fast.
Exactly. Hey, is Elon one of the new CEOs in your view?
I think he's a different CEO. Well, I think there's, there are very few individuals like him. And, in many ways, the impact and influence he's had in his space. Yeah, I would say he's definitely in that new category.
That was Ty Wiggins, global lead of CEO and executive transition practice at Russell Reynolds Associates. His book, The New CEO, Lessons from CEOs on How to Start Well and Perform Quickly.
You're listening to Bloomberg Businessweek. Coming up, revenge travel. Is it losing its appeal? Are travelers still booking that wellness trip to Dubai? Are you, Tim?
Nope.
Okay. Well, we'll see what the Hilton CFO, Kevin Jacobs, has to say about all of this.
Plus, golf's growing interest from women since the pandemic. A member of the PGA team shares more on the other side. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Bloomberg Opinion's Andrea Felsted writing this past week that after 3 years of rushing to book trips in the wake of pandemic-era restrictions, sharply higher fares, protests against tourism, fatigue from endless hours spent in airports, and income squeezed by inflation are all taking their toll.
That was top of mind when Kevin Jacobs joined us. He's president and CFO over at Hilton Worldwide Holdings, home, of course, to 23 brands, including Hilton Hotels and Resorts, Waldorf Astoria, Hampton, DoubleTree, Embassy Suites, and new brands like Spark by Hilton and Live Smart Studios by Hilton.
I think leisure travel has been normalizing off of kind of the boom that it had during COVID, but we're still seeing growing demand for travel. And in fact, most people expect the summer travel season to be quite strong. And, business travel is coming back, and group actually is leading the way, which wasn't the case during COVID, but you now have a lot of pent up demand for meetings and events that is fueling growth in our business as well. So we're still seeing trends. Certainly same-store sales growth is not going to be what it was last year, but it's still going to be quite strong for this year going forward.
So where are you seeing the best growth, the biggest growth? Like which portion of the hotel properties or which brands are seeing the best growth?
Well, if you so really all of the brands are seeing the best growth. The higher segments are growing better than the really lower segments at the moment. And our same-store sales outlook is 2 to 4% for the year. And we think the U.S. will be sort of at the lower end of that range. And everywhere else outside of the U.S. will kind of be at the higher end of that range. So international growth is still a bit stronger than the U.S., but still growing, reasonably well, like kind of low single-digit same-store sales growth.
But you're seeing sort of the same growth, whether we're talking sort of the budget lower-end brands in the portfolio versus the high-end brands in the portfolio?
Well, in our portfolio, we don't have a lot of budget. We have a premium economy brand that you mentioned called Spark, and we're really not as distributed at the really low segments, which, they've been a little bit weaker, but a lot of that has to do with more difficult comparables to last year because they were quite strong. And there's a little bit of an effect of that consumer sort of slowing down a little bit. But mostly across our growth is pretty consistent across the segments that we operate.
Any signs of softness or folks trading down at all
We're not seeing trade down, and we're not really, again, other than the really low end of the business, which is a little bit lower than where we operate, we're really not seeing the consumer pull back. The consumer still feels, really solid.
All right. We know you guys have a ton of properties, about 7,500 properties, including timeshares. I think that was at the end of last year, I think, when I was checking some of the data points. You own a small amount, you manage a bunch. The bulk, though, is franchisees. What's top of mind for your franchise? They're not franchise. That's like a grilled cheese sandwich. Franchisee owners. I'm a little hungry. What are their stress points? And again, does the growth kind of mirror, or the upside mirror, what you are telling us that you've already kind of shared with us?
Yeah, I mean, like you said, upwards of 80% of our hotels now are franchises. We manage a bunch of hotels, and our ownership segment is quite small, but their outlook is quite good. Our construction starts, so new development. First of all, we think we'll open nearly 2 hotels per day this year, right? So our prospects for growth are quite strong. Most of our franchisees are seeing the same thing we're seeing. The prospects for development are quite good. Our construction starts, so new hotels going under development, was up 45% in the first quarter. We think that will continue to be up this year. And we think we'll start more rooms under construction this year than we did pre-pandemic. So I think, look, it's not equal everywhere. And, our franchisees are looking at prospects for revenue growth. They're thinking about their cost profile, right? Because with this great inflation that has fueled the revenue in our business, there's been cost inflation. So we're working with them to think about how to drive incremental cost savings in the hotels. But generally speaking, our owners and franchisees are quite bullish as well.
We want to talk a bit more about the cost equation, but I want to go back to that, 2 new hotels every day. You guys did come out with some news about expanding your lifestyle portfolio, doubling it to 700 hotels within the next 4 years. How come? How and where? Like, where are you doubling? Where are you opening 2 new hotels every day?
Well, it's really across the globe. And so, we put out a press release about our growth in lifestyle. We're celebrating our 10th anniversary in the lifestyle space. The lifestyle segment broadly has grown 50% over the last 5 years. And it's been double the additional hotel count in lifestyle hotels has been double that of the broader industry. So these are very popular type brands. We've been in the space for a while. We recently acquired the Graduate brand, and we entered into a joint venture with another group to bring the Nomad brand, which is a luxury lifestyle brand, into our portfolio. So we now have 6 great lifestyle brands. And we think we can go from what we have 350 lifestyle hotels today. We think we'll have 700 within the next 4 years. And the growth will really be around the world.
So, Kevin, how do you make sure that the new properties that you add, as you mentioned, 2 new hotels per day around the world, how do you make sure that the franchisees are geographically protected from competing with Hilton and other owners of Hilton when they're out there?
Well, we're pretty careful. Look, the interests are aligned, right? Virtually 100% of the capital for our growth comes from hotel and people investing in hotels, either building new hotels or buying hotels and affiliating with them in our brands. And we're invested in their success, because if they're successful, then they will choose us for their next deals. And that obviously enhances our growth rate. And so the way you do it is you're just very careful. We work with each and every new hotel deal. We work with our partners to find the right locations for the right brands. And we want and need each of our hotels to be successful. So it's pretty self-regulating. Interests are aligned, and none of us want to put a hotel on top of another hotel where they're going to compete too much. And the reality is it's up to us to keep growing our customer base, having our brands be strong, and driving that premium performance so that our owners make more money when they invest with us. And if they make more money when they invest with us, then they'll choose us for their next deals, which enhances our growth rate.
Hey, Kevin, our Bloomberg Intelligence team of analysts noting that you guys cleared your debt maturity schedule before 2025, the majority now due in 2028 and beyond, cushioning it against sector headwinds. So it sounds like it really gives you guys really some, freedom to move around no matter what might happen in the economic environment, at least for a couple of years. Is that fair?
We've always been focused on financial flexibility, right? So it's not just the ultimate quantum of our debt or the cost of our debt, which of course we care about a lot, but we're always looking for opportunities to push maturity. We have one small maturity in 2025, and then we don't have maturities for a while. And that served us well in COVID. In COVID, when our revenues went to near zero, we didn't need to amend our credit facility because we didn't have any near-term maturities. We didn't breach any covenants. And so we've always been really focused on financial flexibilities.
That's Kevin Jacobs, president and CFO at Hilton Worldwide Holdings.
So Hilton is home to golf properties, in case you didn't know, and increasingly you may find more women playing on those properties. Thanks to the pandemic, more women are engaging in the sport.
The National Golf Federation reported last year that one of the most notable aspects of the pandemic-driven rise in participation over the previous 3 years was the influx of women and girls. It noted that there are about 6.4 million female golfers. That's up from 5.6 million in 2019, with the female golfer pool jumping 15% compared to a 2% lift among male golfers.
All right, so that brings us to the Women's U.S. Open, which wrapped up last Sunday at the Lancaster Country Club in Pennsylvania. We talked with Jill Spiegel, president of the PGA Tour Superstore, ahead of the final round.
Really fun to watch. 26% of all golfers are women, and 60%, a lot of new people came into the game, and 60% of new golfers that came into the game over the last few years have been women. So we anticipate that 26% climbing over 30 here in the near future. And what's really exciting as well is, over 40% of 18 and under golfers are girls, which is great. So that trend is going to continue. And it's really exciting to see, not only in women's golf, but in women's sports in general. If you look back just a couple of months ago with the craziness around Caitlin Clark and how that's translated into the WNBA, it's really exciting. And, viewership is much, much higher on the LPGA, and the media consumption is 12 million viewers a week versus just 4 million a few years ago. So it's really fun to watch. We are very supportive of the female customer in our stores. In several of our locations, we lead with women's apparel. In our resort locations, we actually sell more women's apparel than men's apparel. So it's always been an important business for us, but we're continuing to really focus on it and continue to grow it. And if it's 26% of the business, we want it to be 40% of ownership.
I want to take a step back. Why do you think more women, more girls in particular, are engaged? What is it particularly? Is there a player? Is it what's going on?
Well, you do have that. I mean, you have Nelly Corda, which has been amazing to watch. She's won 6 of her last 7 tournaments. And I think COVID was really good to the golf industry in general. And I think it attracted more women at the time. People, adults who are working from home had more flexibility and were getting out on the course. And you're seeing the demographics changing a lot, which is nice. It used to be middle-aged white men, and you're seeing, not only are you seeing more women, but you're seeing more people of color and a lot more youth. So it feels more accessible, more fun. It's, I think golf can be very intimidating if you're new to it. And I think some of those barriers are getting broken down. And I think it's a little more casual than it was.
I'm wondering about how much that growth from the COVID era has continued. I'm a cyclist, and I think the cycling industry got a huge boom during COVID, but it is just getting crushed right now. Some sports are not seeing that bump continue. What can you tell us about golf?
Well, it's a really good question. And, you quoted some stats from the NGF, and we look at it closely too. And 2023, 2020 and 2021 were record years. And the last 4 years, rounds of golf have been at an all-time high, with 23 at a peak. Over 530 million people, rounds of golf were played, and participation was almost 27 million. And in 2024, rounds of golf are up over 2023. So we were all holding our breath. Our business doubled during COVID, which is tremendous. And we were thinking, when is the air going to come out of this balloon? And it really hasn't happened. The industry has never been healthier. And what's exciting to see too is not only are people playing golf on the golf course, more people are actually playing off-course golf. And when I talk about off-course, what I mean is simulator golf. They're either going into a 5-iron or a Top Golf. And 10% of those people are converting to green grass golf. So it's the growth continues. And you're right, there's a lot of sports that saw a huge spike during COVID, and they're regressing down. In golf, recreational golf has never been healthier. 1 in 9 people are playing golf. And the beauty of it is all ages can play, all abilities can play, and you can play together regardless of your skill level. Now it's, people are sparking an interest, and we're seeing in our business, the technology business is really, really healthy, and the simulator business is healthy. And, there's a launch of an interactive league starting this January with professional golfers called TGL, and you're going to see that 24 of the top players on tour playing simulator golf down in Florida on Monday night.
That's really cool.
There's this whole resurgence of different ways you can take in the sport, and simulator golf doesn't take 4 hours, and you can play it in a couple hours or an hour even. So it's opening it up and making it more welcoming, without the time commitment.
That was Jill Spiegel, president of the PGA Tour's Superstore.
Still ahead on Bloomberg Businessweek, the hotelier that says it's time to stop putting guest needs first. And on the flip side, the hotels that are finally prioritizing one significant group of travelers.
It's coming up in Pursuits. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
The hotel with no front desk, no keys, no set check-in, and if you get hungry, well, the local villagers will cook for you. Sorry, guests, your needs are not really top priority. Contrast that, Tim, perhaps with hotels definitely and finally putting one group of travelers first.
And once you get to a hotel in New York City, how about the best shows to see? It's time for Bloomberg Pursuits. With us, the editor of Bloomberg Pursuits, Chris Rouser, and Bloomberg News travel reporter, Lily Germa. Chris, I want to start with this great story that Lily wrote about hotels finally catering to neurodivergent travelers. First, I think the term neurodivergence is not on everyone's radar. So talk a little bit about that.
Yeah, I mean that's a great point, actually, and I think if sometimes if you put something like that in a headline, people say, "Oh, I don't know what that means." So that that means it's a whole spectrum of things. From people experience autism to other disorders, and it means that going through the world can be quite different. And in Lily's story, we talk about how 78% of individuals or families who experience neurodiversity don't travel. Wow. They just don't bother.
Terrible.
This is specifically autism, actually. Yeah. And that means because loud noises can be a problem, textures can be a problem, lots of people can be a problem, and it can be such a headache that families just stay home because it feels safer and it feels easier. And finally, some hotels are figuring out how to make travel easier so that families who want to try it and want to see the world can actually do it.
I love it because for kids, it's so important. Whoever they are, whatever their background, whatever they are dealing with, it's really good to experience life in some way. So, Lily, I'm curious how this story came up on your radar, and then talk to us a little bit about what hotels are doing.
Sure. So I noticed that hotels were increasingly getting their staff certified to, understand how to handle and how to serve neurodivergent families. And there were a couple of surveys that came out in April from Hyatt hotels. And I thought, well, this is interesting. It seemed like to be, a bigger push. And that's pretty much what's been happening with some of the larger hotel brands, including Virgin Hotels, Hyatt Hotels, some of the resort brands in the Caribbean, such as Charisma Hotels. And they are going to a couple of different certification bodies to train their staff and know how to handle, any situations that come up at the hotel or understand what the needs might be for neurodivergent families. So I thought, well, this is interesting. It seems to be gaining traction. And I learned quite a bit as the research unfolded. Yeah.
So Lily, I'm really interested in not just the hotels, but the travel agencies that have sprung up around this. Tell us about Magical Storybook Travels.
Yeah, so Magical Storybook Travels is led by this lady who early on discovered that her son had ADHD and didn't really know, how she would continue to travel. And when she asked her peers, they were all like, well, we just don't go anywhere. And she didn't want that to be her story for her family. And so she set up this agency, and she trains basically families to be ready to handle their first vacation. And that includes several meetings, what she calls, pre-travel counseling, where they sit together and she goes over what works for them day to day in their, regular routine, what doesn't work, what's a trigger. And once they go all over all of that, and she starts getting ideas together for them of where they could go. And she usually recommends certified hotels or destinations that she thinks they could handle. But sometimes they want to go to Disney World. So that definitely requires, ideas on how they could handle a whole vacation there. And what she does is she tells them to go and spend the night at grandma's, for example. Get used to doing something different away from home. And so it really is a long process for these families.
And she knows, for the hotels that she recommends, right, Lily, she can provide video tours or show them video tours. She knows floor plans. She knows about sensory triggers that she can tell people about. And she, that really helps. All that prep really means everything.
Yes, absolutely. She did mention that was a big part of her work, was the video tours for the kid to be able to visualize himself or herself in a place, so that's a part of her job as well.
What's interesting too, I was thinking, what about things like a Disneyland or a Universal Park, where I think, any of us who've got kids, one of the best things is taking our kids to experience that Legoland. I know Tim went there with his son. I just think how magical that is. Are they, those types of institutions, those companies, those types of experiences, are they warming up to this and providing opportunities for kids?
From what I understand, Legoland is one of them. Disney World, that's from what the travel agent told me, their hotels are not doing so well in this area, but the actual parks are. So that's an interesting, a differentiating factor. But yes, some of them are warming up to it. I will say that, we could say about 200 of them have been certified with IBCCS, which is one of the main bodies. Maybe 100 more with another one, but it generally there's it's not enough, and I think that it should really speed up.
I think what's interesting too is, and you write about it in the story, about employees really becoming sensitive to families and their needs so that they can help parents when their kids need assistance, whether there's a meltdown or something, and helping with other people, in the general public who always think they know better and they really don't necessarily.
Yeah, that was really eye-opening for me as well, because a lot of times you might see, a kid having what we call a tantrum, but really it's not behaviorally caused. It's a neurosensitive condition.
All right, so we want to go from finally meeting the needs of an underserved group to another approach in hospitality about stopping putting guests' needs first. I love this story. It's kind of a place I want to go, although I don't think I can afford it. Chris, tell us, though, about this story and, I don't know, the pitch or how it kind of came.
So first of all, Lily, as you may have noticed, is an expert on sensitive travel. And she has a column that we've recently started with Pursuits called the Better Travel Bureau, where we talk about the business of making tourism more equitable, more inclusive, and less harmful to the environment. And we talk about the people, sort of transforming the industry and figuring out ways to make travel not only less harmful, but actually a positive influence on the world. Yeah. And because we really believe in travel. Sometimes people are like, oh, if you really care about climate change, don't travel at all. And we just don't see the world that way. And travel can be everything from taking the train to something that's in your city's backyard to going around the world and doing some ecotourism and learning about communities that you never would have known about. And so Lily has found a very interesting hospitality project that really involves a community and is actually much more about the community than it really sort of is about you, the traveler. So, Lily, you want to tell us about it?
Sure. So I have to credit our incredible travel czar, Nikki Exting, who actually tipped me off on this, on Thierry Tessier, who's this really avant-garde hotelier, and started this new concept, that's called 700,000 Hours Impact. And he's been in the industry for a really long time, but he says that it took him just about as much time to realize that hospitality really should be about elevating and empowering communities, and not so much about catering to guest whims. So that's really interesting, because he's on a very, he's on a luxury bracket. He does his hotels in a very unusual way, where you don't have a typical restaurant or check-in hours. You're basically free to vacation the way you like. And he has these pop-up surprise dinners and lunches in different locations on the property. But now he's, he did this every 6 months in a different location, and he had a very huge following, that would go wherever he was. But he realized that his 6-month pop-ups were harmful to communities because they've become dependent on the revenue, and then he would just disappear again for another 6 months. So he decided to, change the model. He partnered up with an expert in international development who's worked on, different projects in the Global South for many years at the World Bank and other institutions. And together they've come up with this really unique model where it's still a small, what they call micro hospitality. So they only have a certain number of guests per year, per season, about 50. And it's about $1,000 to $2,000 a night. But before you can even book, you have to donate. So it's like a membership fee. and
if you don't, right, there might not be a room available, basically.
Yeah, if you give 500 euros, you might not, just might not be able to go. But once you donate, then you book, and while you're there, you get to experience, a whole range of locally owned cooperatives that are providing the activities, but also building businesses. So you automatically know that your funds are going towards setting up these cooperatives, and the idea is for these communities to become independent long term.
I have to say, this looks fascinating. I love the trend. We didn't get to it, but I'm just going to give Chris 30 seconds. Best show in New York City. There's a lot going on.
Yeah, so there are tons of shows open this spring, like dozens literally in New York. Dance shows, Broadway, blah, blah, blah. And so we did a recommendation list of what to see this summer. And my top two picks are Oh Mary, which is a hilarious sketch from the comedian Cola Scola. Was downtown, has a brief Broadway transfer. You'll laugh until you'll cry.
Mary Todd Lincoln, right?
Mary Todd Lincoln as an alcoholic cabaret star.
I'm in.
Nothing like it. It's completely idiotic and totally brilliant. And then there's Cats at the new Perlman Performing Arts Center.
What?
Yeah, which Mayor Bloomberg is a big sponsor of. Yeah, Cats, and it's not.
They
Cats.
do have 9 lives, Tim. Sorry.
It's not Cats with ears and tails. It's reinterpreted. The cats are actually in ballroom culture, so like voguing down the runway. I think the show Pose. And it's we did a story on the costumes. All the costumes are tearaway. It's going to be wild and crazy, and everyone's going to be talking about it.
Okay. The Outsider is also on the list, which I've heard is just fantastic.
Yes,
good one.
It's very original, and people really like it.
Cat sounds perfect.
Okay. I guess we got to go. Hey, a big thank you to Bloomberg News travel reporter Lily Germa, also the writer of the Better Travel Bureau column and newsletter. So do check that out on the Bloomberg terminal and at Bloomberg.com. And also the editor of Bloomberg Pursuits, Chris Rouser.
The amazing Chris Rouser. All right, everybody. That wraps up the weekend edition of Bloomberg Business Week from Bloomberg Radio. Thank you so much for joining us.
Be sure to tune into Bloomberg Business Week Monday through Friday starting at 2 p.m. Wall Street time on Bloomberg TV, Bloomberg Radio, and on Sirius XM, channel 121. You can also listen to us on Apple CarPlay and Android Auto free in the Apple App Store or on Google Play.
You can also watch our daily broadcast on YouTube. Just search Bloomberg Global News. We're simulcast too on Bloomberg Originals.
Get our podcast at Bloomberg.com, Apple, or wherever you get your podcasts. And the latest edition of the magazine, always available on newsstands at Bloomberg.com and on the Bloomberg terminal. I'm Tim Stenovec.
And I'm Carol Massar. Have a good and safe weekend.